Hi, this is Keith Schneider, CEO of MarketGauge.com, and it's June 5th, 2022 edition of Market Outlook. So, interesting week. We sort of paused, not unexpected after that monster rally off the lows. So, a couple things to note. Number one, if you take a look at the 50-day moving average across all of the key indices, we are still under it. What that means is we've got bearish phases across the board. One interesting thing to note here is IWM is basically the closest to potentially taking out that 50-day moving average, which would put us in a recovery phase. Of course, the other thing that is trading consistently is that on real motion, we are also under the 50-day of real motion as well. So across the board, pressure still on. One of the lead indicators would be if IWM could regain that 50-day moving average. Now, one other thing to note is IWM, the small caps, got hit the hardest and really had a period of vast underperformance throughout 2021 and led the market on a decline. Now, what's interesting is you can see at the end of May, we never had a new intraday low, which we had in the Dow, we had it in the Qs, and in the S&P that was rejected, and now the rally. So if the lead index on the downside is losing steam, you can make a potentially bullish case for that index, which may be a lead indicator overall. But we really need to see this take out its 50-day moving average and close above it, and that could be an important clue as to the intermediate direction of equities in general. Okay, now moving on to utilities versus the S&P, this intermarket relationship is an important one of my actual go-tos in terms of looking at risk on and risk off. And certainly you can see here that the S&P with Friday's close actually gave up some short-term leadership. As you can see, the S&P really broke down hard on a longer-term basis. So this one intermarket relationship is still showing risk off. Okay, now moving on to volume analysis. There's been a lot of talk about this. There's a lot of talk that the thrust off the lows was extremely strong, hence a reversal and the end of the bear market. Now, what's interesting about that reading is there are a couple classic indications and intervals that are being used, and both of them in terms of the readings like the Zweig and the McClellan, that normal indications were 2-day breath up thrust, or even a 10-day on the McClellan. But the issue here is that they were actually extended and we didn't get great volume. Now, one of our indicators, which is interesting, it looks at volume from one day to the next over a 2-week period. And I often find this is a bit more interesting because one of the patterns that we've been seeing across the board is that volume is always exceeding the 50-day moving average on the downside, and the upthrusts are relatively weak because the buying has been now moved to the dark pools. So what's interesting, very tough to get a good read on volume, but nonetheless, this one, our read here, is still relatively avoiding those pitfalls because we're overall looking at volume on a day-to-day basis relative to one another. And what's interesting, the S&P is sort of slightly neutral to positive, where the other three indices all have less accumulation days than distribution. So not overall a positive sign. So I would say mixed bag overall. I would more heavily weight the S&P as an important indication relative to the other indices because it's really the key benchmark that we like to use. However, as you can see, it's still what I would call marginally positive to neutral at best. Okay, now moving on to looking at sectors, I think the key thing to note is that energy, crude oil prices just exploded. You can see what led the index over the last 5 trading days is the energy sector. So net inflationary pressures still exist or accelerating across the board. One thing that's obvious is energy is up 61% year to date. That's very, very strong. The other thing that's interesting to note is the risk off sector, right? The go-to utilities, also the only other sector that's up on the year. So net, you still have an overall negative read looking at the sector rotation. Did we have some good buying and a correction of some oversold conditions in consumer discretionary? Absolutely. But again, the biggest feature and the strongest sector was the energy sector, and that is definitely inflationary. Now, a couple of other interesting patterns as we move on to market hotspots, and that is the pressure, the upward pressure on energy is actually putting some upward pressure on clean energy as well. And also, even though it's not necessarily showing up on just today, but if you look at for the whole week, look at this, right? Energy up 5.7%, solar up 5.6%, and clean energy in general also up almost 6%. So bottom line here is what we've got is a lot of fallout from very, very high energy prices, making plays in the clean energy sector from solar to just clean energy in general start looking attractive, especially on a cost basis relative to fossil fuels. All right, hope this all helps. See you next week, and good luck with your trading.